Management podcast for February 6th, 2013. This is Brendan, and today Tom and I are going to be talking about target retirement funds and age-based funds. So Tom, when you retire, do you want to be getting swung around by the stock market?
I don't have a single client who wants to have the volatility that comes with the stock market when they're retired. I mean, and I have a good number of clients. They just don't want to take that risk. They've been working really hard. They've saved a lot of money during their working career. And now they really don't want to have the stress of the volatility that comes with investing in the market. They know that they need to have some money growing for them, but they'd like to have the lion's share of their money in things that have less volatility than what we've certainly seen the last couple of years in the stock market.
Right, and I can't blame them for wanting to be safe at that point in their investing career.
Yeah, more conservative more than anything else.
Yeah.
So, and the other thing is, you don't know where interest rates are going to be when you retire. For the folks that retired in the 1980s and 1990s, they were still actually able to capture good yields outside of the stock market, whether they went into treasury bonds or whether they went into bank CDs. They were still able to get really good rates compared to what's out there today. In a way, I kind of feel sorry for people who are planning to retire right now or just retired because they're looking at taking their money into lower volatility type investments like CDs or treasuries, and they're just not getting the returns that are out there. And so it's really hard because now they're going to be dipping into principal instead of some of the gains that they might have had were they able to retire 10 or 15 or 20 years ago.
Right, and that's not a good thing.
No.
So likewise, when your child is getting ready for college, should that 529 account be all in stocks?
Again, this is money that's needed for a really short-term event. I've got a lot of the short answer, Brendan, is I don't think it should be in stocks if you're going to be taking the money out sometime in the next year or even 2 years to pay for college. You don't want to be there when there's the opportunity to lose 10 or 15 or 20%. College costs a lot of money. You don't want to compound that problem by taking losses in a 529 account. So really, as your college age child is starting to get to that point where they're going to be taking money out for college, when they're turning 16, 17, you really need to be turning down the volume on the account. Get that volatility a lot lower. So you may want to think about things like short-term bonds or things that are really more conservative than the risk that comes with being all in the stock market. Does that make sense?
Yeah, it definitely makes sense.
Okay. Along those lines, with 529 plans and 401k plans, there's a lot of these target retirement funds or what they call age-based funds. I get a lot of questions on these. The biggest sellers of these funds are Vanguard, Fidelity, and Rowe Price. And so right from the Rowe Price website, it says the objective of these age-based funds and target retirement funds is to provide the highest total return with the emphasis on capital growth or income. And the strategy behind this is to invest in a diversified portfolio that represents different asset classes, different sectors. But here's the thing, as the fund gets closer to its target date, the allocation is going to become more conservative over time based on Rowe Price's predetermined glide path. So instead of going from, say, 100% in stocks to 0% in stocks next year, what they do is they gradually turn down the volume from 100 to 90% to 80% to 60%. So the volatility gets slower. In practice, sounds like a good theory, right?
That definitely makes sense. So let's take a look at an example of a fund.
Okay. This is the Rowe Price 2040 fund. Now, we're recording this podcast in 2013, so this is really designed for someone who is going to be retiring around 2040, that would be someone who's, say, 37 or 38 years old. And currently, the makeup in that fund is 90% stocks, 7% bonds, 3% cash. I'll tell you, there's a lot of clients who are 37, 38 that would say, forget about the bonds, I want to be 100% in the market. Now, the makeup of the money that's in the market, get this, 74%, 3/4 of that money is sitting in large cap stocks, and 21% is in mid caps, and just 5% in small caps. Now, personally, if I were managing this account, I'd have a completely different mix, since on our charts, the point and figure charts have been telling us now for a long time that small caps and mid caps have really been beating the pants off of large caps. So I would have a different mix. I'd have way more in small caps and mid caps and less in large caps.
So they're 90% in stocks.
Right.
What stocks do they own?
Boy, that's a great question, and I think a lot of people don't even know the answer to this. What stocks do they own? Well, they actually don't own any stocks. What they have is, when that 90% is going into stocks, they're actually investing it in other T. Rowe Price mutual funds. So if you own the T. Rowe Price 2040 fund, 22% of the stock portion is in the T. Rowe Price Growth Stock Fund. 20% is in the T. Rowe Price Value Fund. 7% is in their international fund, another 7% in the overseas fund, 7% is in the T. Rowe Price Equity Index 500. That's the S&P 500. I think it's really important to know that when you're investing in these age-based funds or these target retirement funds, that what you're buying is a basket of other mutual funds. It's called a fund of funds, and I think a lot of people miss that.
Yeah, I could see people missing that too. It's a little bit misleading.
Sure.
So that was an example of the 2040 fund. Now we're going to check out an example of the 2010 fund just to see the difference between the two.
Right. Now remember, that 2040 fund was 90% stocks. The 2010 fund assumes that you're around age 65 in 2010. That was 3 years ago. So this is for someone who's really now 67 or 68 years old. Look at this. 51% of this investment is sitting in stocks. Do you really want to have that when you're 67 or 68?
Personally, no, but
I don't know. I think a lot of clients, I know they need to have some kind of exposure to things that are going to grow their portfolio, but more than half, I don't really know. 42% of it is in bonds, 5% in cash, and we clipped this little line from the T. Rowe Price website. You should choose the retirement fund with the target date closest to the year you reach age 65. So this is someone who in 2010 was an owner of this, would typically be someone who is 65 years old. Now they're 68. And let's talk about risk. In 2008, a lot of people lost money in the stock market. If you were in this investment in 2008, say you were 62, 63 years old, you're getting ready to retire in the next 2 years, this fund dropped 26%. You lost a quarter of your money in this investment in supposedly something that's getting more conservative and going to be there for you when you retire. I don't think so. And so I think a lot of investors are going into these funds without knowing some of the details of where their money is actually being invested. And that is really, what we try to help our clients with here. So, when we do talk about investments, remember that none of the securities that we mention in this presentation or any of our presentations represent a past specific recommendation of Mullooly Asset Management. This presentation is not a recommendation to buy or sell any of the securities that we mention here. And quite frankly, if you're relying on a podcast for investment advice, we think you're making a huge mistake. So we strongly urge our listeners to consult with their investment advisor before they make a decision whether to buy or sell any kind of investment. Now, if you don't have an investment advisor, you can feel free to contact us. You can find us on the web at mullooly.net. That's MULLOOLY.net. or you can call us at 732-223-9000.
That's all we have for this week. Glad that we could talk about target retirement funds and age-based funds, and hopefully you learned something, and we'll see you next week.